is on our radar on the back of its second quarter results. Disbursements grew by 7% on a sequential basis but declined 21% on a year-on-year basis. The company also saw an uptick in the net income and net profit both on a sequential and a year-on-year basis. To discuss more on this and the outlook going forward, Shachindra Nath, the founder and MD of Ugro Capital, is joining us on the show. Mr. Nath, good afternoon. Thank you so much for joining in. I'd like to start off by asking you, because the prime part of your business is the robust the disbursals, and what is your outlook going forward there? Your disbursals were up on a sequential basis, but on a year-on-year basis the number is slightly lower. How do you see that going forward in the second half of the year?
So I'm sorry, we had our lifetime highest disbursement in this quarter. So I don't know where you're picking up the data. So we did 1,971 crore of disbursement in this quarter, which, since we started the company in mid of 2018, this is our first and highest quarter disbursement. And we believe this is a result of the very strong base of distribution which we are continuously building. The micro enterprises branch rollout is happening. We are now at 210 plus location. We'll be at 250 location this year and 400 location next year. We continue to believe that, I think so, we will continue to maintain the momentum. It is also, as you know, NBFC as a segment of the market, regulatory narrative is pretty negative. But, we are getting, because we are a dedicated MSME financer, we are benefiting from the constraint which is being put on consumer financing, personal loans, so on and so forth. So I think so our long-term target is to be India's largest small business financing company, and we are on that path. This quarter, actually, we had seen real momentum in our micro enterprises segment, our prime segment, machinery. All of our engine fired. Our liability engine was very, very strong, and we were able to maintain the credit cost.
All right, that's interesting. You're able to maintain the credit cost as well, because this at a time when a lot of the other NBFC peers are speaking about some sort of stress in the credit situation right now. If you could give us a sense on how that is likely to pan out, credit cost guidance for this year, along with guidance on the net interest margins as well, because going forward, two trends are looking imminent. One, the cost of funds increasing, and the second one is, of course, the credit costs or the credit quality showing signs of some sort of stress. If you could give us a sense on that.
Yeah, so my request to people like you who actually build this narrative into the market is to segregate and differentiate different type of different segment of the market. We run this campaign called MSME Achha Hai. We do publish a report which is along with DNB every 6 months. What we are seeing that this narrative that there is a credit cost or there is a ballooning of assets is happening is more, even if you look at RBI commentary, it is more driven for retail credit, and retail credit means consumer, personal loan, and microfinance institution. MSME is a segment of the market, especially the bottom of the pyramid, which we call 15 lakh turnover to 4 crore, 3-4 crore turnover small businesses. We are seeing very robust, cash flow generation happening to small businesses. And that's why we think so that MSME in this, next 3 to 5 years would be a mainline activity, and there is an opportunity to build a mainline financial institution. So this, this clubbing of overall NBFC scenario, microfinance, housing finance, consumer finance to MSME, time has come there wherein, we segregate MSME financing in India separately to the rest of the NBFC pack.
Mr. Nath, your provisions have increased on a sequential basis. I wanted to ask you what led to that increase in provisioning, what demanded that, and which is the sector within your business that demanded that excess provisioning?
No, actually, look, if you look at our guidance, we have said 5 things. We have said that Ugro is targeting to achieve a 4% return on asset and 18% return of equity by end of 26. And that is a function of OPEX leverage, portfolio yield going up, a little bit of contraction in our cost of borrowing. And we have said that our credit cost on a steady state basis should be at 2%, which was roughly around 1.5%. So as the maturity of the portfolio and as the growth would come, the total credit cost and provisioning would get to that level. The way we design the business is by product line. So we have a prime secured business, we have micro enterprise business, we have machinery and green financing business, we have embedded financing and retail merchant financing business. As the portfolio matures, you have to take more provisioning. in line with the anticipated credit cost. So this is a sheer function of our scale, size, and maturity of the portfolio. We continue to believe that our gross NPA, on a steady state basis, will remain at around 2.5%, and our credit cost all through the cycle would remain around 2%.
All right. Just to way back on the margin front, I wanted to know two particular things. One, how much of your NIM expansion this time around was on account of lower cost of funds, and how much of that was on account of increasing yields? If you could break that up for us. And as central banks world over, including at some point the RBI, looks at reducing interest rates, what would your NIM targets be?
Yeah, so look, we have said that our portfolio yield in next 6 to 8 quarters would go up by 150 basis points. This increase of 150 basis point is happening because our micro enterprise business, which is loans below 25 lakh rupees, which are originated through our branch network, whose contribution was 10% of AUM, would go up to 35% of AUM by 2026. And because that engine generates secured loan in the tune of 18 to 19%, the portfolio yield would increase by 150 basis points. We have then said that we will have a 75 basis point of cost of borrowing reduction, of which we believe that around 50 basis point would happen because of maturity of the business. We have got 2 rating upgrades. We have raised around 1,265 crores of capital. So in sequential year from now, the more profitability which is coming into our business, rating upgrade and maturity would bring around 50 basis of cost benefit. We are not seeing that right now because liability market had remained constrained for NBFC, not for us per se. And around 25 basis point we have presumed in either in Q4 or Q1 of next financial year to start happening because of the rate cycle changing from now.
All right, Mr. Nath, thank you so much for sparing time and taking us through the quarter gone by and the road ahead as well for Ugro Capital. Wish you good luck for the second half of the financial year. That was the management of Ugro Capital, the stock trading with gains of just around 1%. Now, as we slip into a break, here's some good news.